Good morning and welcome to the webinar on the Employee Retention Tax Credit. My name is Jim Donovan. I'm a partner here at Eide Bailey in our Federal Tax Credits and Incentives Group. And presenting with me today is Joe Stoddard, who's also a partner. He actually leads our group in Federal Tax Credits and Incentives. And so we're excited to walk you through what you need to know about the Employee Retention Credit. And really, this is some legislation that kind of flew under the radar in the CARES Act, but with the extension and expansion of the credit in late December, it's really now a more important item. So with that, what we'll do is we'll give you an overview of the ERC. We'll talk about what is an eligible employer. We'll cover qualified wages, and that does include some health plan expenses, as well as other considerations that you need to know about when claiming the ERC, or gosh, do I qualify for the ERC? So we have a full agenda today, and we'll get right into it. All right, so as I mentioned, with the CARES Act that came out in March of 2020, the big star or the big provision in that one was the PPP loans. And for the most part, it was a much better answer for most of our clients in terms of getting cash to keep the business running. And, with that forgiveness, the return on the loan was pretty darn good, right? So the employee retention credit was out there. But for the most part, it didn't really apply to a lot of taxpayers because they were taking advantage of the PPP loans. With the extension and expansion of the credit, it made some retroactive changes that allows, basically they're no longer mutually exclusive, the PPP loan and the ERC. So this is a big deal to a lot of companies now. So that's why we're talking about it. We're getting a lot of questions, and we want to help you answer those questions. So what I'm going to start with is some really important concepts here. You're going to see these as a theme throughout the presentation, and there's some different rules that apply for 2020 versus 2021. And so we just want to highlight these right off the bat and kind of have you listen for them as we kind of cover them, because we'll go into each of them in greater detail, but they're just, they're important to know as you consider, hey, am I an eligible employer, or how do I take advantage of the credit? So with that, we'll hop into it. But the first thing is, what is an eligible employer, right? And there's two ways to qualify. First, there's a full or partial suspension of business due to a government order. And we'll get into that with some examples a little bit later. And then there's the bright line way to qualify, is what I like to call it. It's a significant decline in gross receipts. And again, those law or that qualification for significant decline in gross receipts is different for 2020 versus 2021, and we'll walk you through that. The other thing to note is if you're a small or large employer. So small employers can claim the employee retention credit on all wages for all employees basically paid during the eligibility period, whether it's a quarter for significant decline in gross receipts or due to a government order that you're suspended. A small employer is defined as 100 employees in 2020 versus 500 in 2021. So again, different rules there, but just know that, hey, if you're deemed a small employer, you can take the ERC on everybody. If you're a large employer, you can only claim the ERC for wages paid to employees who are not providing services. So again, we'll get into some examples on that, but note that there is a difference, and it does impact the benefit that you might receive. The last thing to note is it is a refundable credit, right? I love telling my clients, hey, I love finding you credits, but if you can't use them, they don't always do you good. But this one's refundable, so you don't have to have tax liability to get benefit here. So your current portion of the credit is first used to offset the employer portion of Social Security tax, but any excess is refunded. So, if you're fully paid up, you can actually get a check from the IRS, depending on, again, if you use the employee deferral, it's a different answer, but if you fully paid up on your quarterly or your weekly remittances, then again, that could be cash back to you. So those are the key concepts to note regarding the ERC. So let's hop into 2020. And I think, Joe, you're gonna hop in here.
Absolutely. First off, welcome everybody to our webcast. I appreciate you taking some time out of your day to listen. We're getting some questions in, so and we'll go into more details, but just so we can kind of keep up with the questions. The eligible employer, and Jim touched on this, it's an either or test. So you can either have a significant reduction in gross receipts or a suspension of operations. So you don't need to have, don't need to show both. So we're looking back at 2020. Jim talked about the fact that originally this was mutually exclusive, right? So you could either take a PPP loan or claim the ERC, but not both. The original ERC was set to expire at the end of 2020. So it ran from March 13th through the end of 2020. And it was a 50% credit. Now 50% on qualified wages, and we will dive into qualified wages. There's some nuances there. But essentially, the credit maxed out at $10,000 cumulative of qualified wages for all of 2020. So you do the quick math, and we've got up to a $5,000 per employee credit. So even though it's not quite as beneficial as a 100% forgivable PPP loan, the numbers still do and can add up. You know, if you have a relatively small company with 50 employees, could still be looking at potentially $250,000 of refundable tax credit. The small versus large employer concept that Jim talked about just a minute ago, for 2020, that is 100 employee threshold. And we'll go into, again, more of those details later on. But essentially, if you're under that threshold for 2020, you can claim all wages paid during the eligibility period. If you're over that threshold, you can only claim wages or health plan costs paid to employees that are not working at least part of the time. So that's kind of what we were looking at for 2020. And most of those rules still apply, and there is some retroactive changes that Jim will talk about here now.
Thank you, Joe. And so with the Consolidated Appropriations Act of 2020-2021, or I've also heard it's been renamed now to the Taxpayer Certainty and Disaster Relief Act of 2020, regardless of the entertaining name, what was passed in December of 2020, provides some key retroactive changes to the ERC. So initially, when we talked about this in the CARES Act, you know, it was, again, mutually exclusive with PPP loans. So you could take one or you could take the other. You couldn't take both. What they've gone back and said, hey, you know what? It's a fantastic benefit. You should be able to do both. So a lot of companies are saying, hey, I didn't really pay attention to ERC, but now I want to go back and take ERC in addition to my PPP loan, right? And so they're saying, well, how do I do that? And the one thing to note here is you can't take the ERC, so it's a wages driven credit, right? You can't take the employee retention credit on wages you use for PPP forgiveness. And now, if you don't receive forgiveness, we can certainly pull in those wages, but if you receive forgiveness, we can't pull in those PPP wages that are used for that for the ERC. There's a couple of other retroactive provisions they put in here. One, and you know, I guess the first one, they clarified gross receipts for tax exempt entities, right? This was something that in the original law they kind of punted on. They said, hey, we don't really have a definition for that. Over the summer, the IRS FAQs answered this question in July, basically said, hey, gross receipts, you know, they're effectively, in layman's terms, they're what you would consider gross receipts on your Form 990. So again, we have that definition. We've had it since the summer, but they went ahead and, you know, put it in the code, which is kind of nice. The other thing they clarified was group health plan expenses are qualified. So initially, when the IRS released their FAQs, they said, hey, if you furlough an employee, and even if you pay their health care, because you're not paying them wages, you can't pull in those health plan expenses for the ERC. Congress didn't like that. They said, hey, that's not the intent of the law. They wrote a letter to the IRS, and they changed that rule and basically said, hey, yes, even if you're not paying your employees, they're furloughed, but you are paying for their health plan expenses, you can pull those costs into your employee retention credit. So again, what they did here is just made it part of the law. All right. So talking about the credit in 2021, you know, like Joe mentioned, this was slated to expire at the end of December. I'll be honest, in early December, when I was talking on a webinar, I really didn't think this was going to be extended. I thought ERC is a fun 9-month deal, but they surprised me, and in a good way, because not only did they extend the credit, they made it a heck of a lot better. So, in 2020, when we talk about that 9-month period, and you can only qualify $10,000 in wages, now in 2021, you can qualify $10,000 in wages per quarter. So for Q1 and Q2, you can identify, hey, $10,000 per employee that you could qualify for the ERC. On top of that, you get an increase in the credit rate, so from 50% to 70%. So now you're looking at $7,000 max credit per employee per quarter. So it's a significant increase. The other thing that they did was they increased that small employer threshold from 100 to 500 employees. So that's really significant. We talked to a lot of clients that they were over that 100 employee limit. And gosh, it was just difficult to get much of a benefit from the ERC because you're limited to looking at who's being paid, but not providing services, right? They're being paid for not working, and a lot of businesses didn't do that. So raising that threshold to now it's, if you're 500 or under employees, you can take the ERC on everybody, not just those that are not providing services. The other thing that's interesting in here is they expanded the ERC to include some governmental entities. So they have a separate tax exempt status, and it's really targeted at state colleges, universities, and hospitals. And what we found initially anyway is a lot of private universities and colleges were taking advantage of the ERC. Let's be honest. Attending online is not the same as that in-person experience, right? So, from that respect, there were a lot of universities where it wasn't fair footing as far as being able to take advantage of the ERC. So this is something that they changed, and it's really a smart rule here to expand the benefit to some governmental entities. Now, if your local school district is asking about the ERC, unfortunately, it's no. I've answered that question, but anyway, again, a nice benefit here. And we'll start talking about what is an eligible employer.
Before I dive into this, we're getting lots of questions, which is great. Many of these questions, you guys are reading our minds. We're going to go into a lot of these answers as we go throughout. So be patient with us. We'll get to many of these topics. We'll answer some of them as we can in written form. If we can't get to all of your questions, we'll get a report afterwards, and we'll follow up after the webinar. Okay, so we're going to dive in deeper now. Now that we've got the overview of the credit, we'll dive into some of the more into the weeds just a little bit. So we're going to start with the whole concept of an eligible employer. And we talked earlier about how this could be either a black and white test, do we meet the gross receipts criteria? Or it can be a more subjective, do we have a partial suspension of operations? So we're going to start with the gross receipts test. And again, there's different rules for 2020 versus 21. So we'll start with 2020. So we need to be able to show a significant decline in gross receipts. And the way we do that in 2020 is by showing that we have at least a 50% decline in any calendar quarter compared to 2019. And then you remain eligible for subsequent quarters until your gross receipts exceed 80% of the 2019 quarter. And that's your last quarter of eligibility. So, I know that's clear as mud. That's the best way we can explain the very convoluted wording in the statute. The example maybe helps some of us understand that a little bit better. So in this example, you can see in Q2, this taxpayer fell below 50% of their gross receipts compared to 2019. So they would be eligible for that quarter. If you're eligible for any quarter in 2020 by the gross receipts test, you'll automatically be eligible for at least the next quarter as well. And that, in this case, since they rose above 80% of their gross receipts in Q3 compared to 2019, that's the last quarter of eligibility. And even though they fell back below 80% in Q4, they would still not be eligible. If this example was tweaked slightly, and if that Q3 percentage was 79% instead of 82%, then they would remain eligible for Q3 and also Q4 because they didn't have a quarter where they exceeded 80% of the prior year. In terms of what counts as gross receipts, There's a fairly expansive definition of gross receipts. So it's your sales, net returns and allowances. It also includes services and rents and dividends and interest and everything. So it's a broad definition of gross receipts gets pulled into this analysis. And while the definition of gross receipts doesn't change for 21, the test does change. So now it's a significantly lower threshold. So we only need to be able to show a 20% reduction in either Q1 or Q2 of 2021 compared to that same quarter in 2019. So we're comparing 21 to 19. We're not comparing to 2020. And if we have a 20% reduction in either Q1 or Q2, that quarter, whether it's Q1 and or Q2 would qualify. There is a provision in the new statute that allows you to look back to the prior calendar quarter. So as an example, if we're trying to qualify for Q1 of 2021, we can either use Q1 or we can look back to Q4 of 2020. And if Q4 of 2020 was less than 20% of Q4 of 2019, then you'd be eligible in Q1 of 2021, if either of those, or if you have a 20% reduction in Q1. Again, convoluted rules, trying my best to explain that, but there's opportunities to qualify much easier in Q1 and Q2 of 21 with the gross receipts test. There is also a rule that if you were not in existence in 2019, you can use the alternative of looking at the 2020 calendar quarter when you're doing that 21 comparison. All right, Jim's going to kind of now talk about the other way to qualify, which is the more subjective suspension of operations test.
Sorry, Joe, I jumped the gun there. I was so excited to talk about suspension of operations. So, Joe covers the bright line rule, which, let's be honest, if you meet that definition, it's cut and dry, right? If the IRS were to ever look at this, it's pretty easy to say, hey, yeah, I qualify. What I'm going to get into is a little bit of the squishy part of the law. And this applies to both 2020 and 2021. But, if you qualify by a suspension of operations, what does that look like? So first thing to note is you would only qualify for the credit during the suspension of operations. So, for example, if you had a government order that, hey, we had to shut down on March 17th, and we were able to reopen on April 30th or May 1, you would only be able to claim the ERC on wages paid during that March 17th through April 30 timeframe. So that's kind of one of the limiting factors and one of the benefits of qualifying under the gross receipts test. Now that 50% hurdle in 2020 is pretty significant, right? So what we're finding is a lot of our clients do qualify under the partially or fully suspended operations test, right? So how do you meet that? Basically, you have to have a government order in place that effectively limits your operations. Now, it may not fully shut you down, but it limits capacity. It limits, the hours you can be open. It basically limits, commerce or group meetings. So it's fairly expansive here, and this is where it gets a little squishy, right? Is gosh, how do we apply this? So the first thing to note is you do need a government order in place. And so most states have issued these orders. In a few cases, you have local orders, but what they don't include is statements made by the governor at press conference or other things that are in interviews or kind of off the cuff, right? We're looking for formal government orders that say, hey, you know what, these businesses are suspended, these businesses are essential, and walks through the time frame basically and what they can and can't do. And again, most states have these. So we've built quite a database of these. So if you think you qualify this way and you were subject to a government order, that's basically how you're going to qualify. So the question also becomes, hey, I was listed as an essential business. Can I still qualify for the employer retention credit? And the answer is yes. Basically, in the IRS FAQs on the ERC, They give us some examples of ways that an essential business would qualify. One of those is, an order limiting hours of operations, and we certainly see that. Also, if you have, suppliers that can't get you what you need to manufacture your product, that would be basically a suspension of business. So I would say that the examples in the FAQs are fairly limited. They certainly don't consider all of the possible scenarios, but they kind of give us some fact patterns to apply. And I would say, we're looking at this, on a case by case basis. We're not trying to take too conservative of an approach on this because there are a lot of companies out there that were certainly suspended. And they really felt they had a government order in place. Now, again, we'll look at that on a case by case basis, but this is a good way to qualify for the credit. Now, one thing to note, you're not partially suspended if you can basically, everyone can go home and telework. And if you've done that in the past, it's going to be hard to qualify that way. The other thing to note is if basically you closed voluntarily or customers are required to stay home and didn't visit your business, that doesn't constitute a partial suspension of operations. So again, this one, a lot of the bright line examples are restaurants, right? The restaurant itself is closed, but you can do takeout, right? That's the bright line suspension, but it can be applied to a lot of different businesses. So keep that in mind as you say, hey, was I suspended? And could I qualify for the ERC? And next, Joe's going to talk about qualified wages.
And as we're doing that, maybe we'll dive into another example that's, there's the bright line examples of the restaurant, for example, that Jim talked about. There's lots and lots of gray area with what's partially suspended. Somebody asked in the Q&A about a charter school, and would a charter school that had to switch to either hybrid or online virtual learning be partially suspended? I think it would be very easy in the early days of COVID where everyone was sent home. There's probably a period of time where classes were not being taught. That at least for that period, it's more of a bright line. Hey, we were definitely partially suspended. What about when you're back kind of up and running, doing regular classes, that sort of thing? How long does that suspension period last? And again, there's no extremely clear answers on this. We don't have FAQs from the IRS that walk through this type of a fact pattern. But you think through, okay, was the lunchroom part of the operations of the business or of the charter school before COVID? And you've got certainly employees, workers in there. You've got bus drivers. You have janitorial staff that are certainly impacted and not able to perform their job function, if you will. And we had some guidance from the Joint Committee on Taxation that gave you a pretty clear guidance that if you've had those types of employees that were impacted, you're partially suspended. The IRS FAQs chose not to go into those types of examples, at least so far. So unfortunately, a lot of this, we're in that gray area. You can make good arguments, but it's not extremely black and white. So just one, and we could go through that same type of an analysis for lots of different industries, but just one thing that came up in the FAQs that just kind of highlights maybe some of the complexity and the subjectivity on the partial suspension of operations. All right, switching gears, qualified wages. So now that we know that, hey, we're an eligible employer, what can we use to claim the credit? So we've talked about these need to be wages that were paid. The definition of qualified wages goes back to the box 3 wages on the W-2, so Social Security wages. And you can also include the health plan expenses. And we have a separate slide to talk through the health plan expenses. There's a rule for 2020 that you cannot, there's a limit that you cannot include wages for your eligibility period that would have exceeded what would have been paid in the prior 30-day period. So you can't give somebody a big raise or a bonus and take the ERC on what they would have been making prior to being eligible, at least for 2020. For 2021, that rule goes away. So you don't need to look back to that prior 30-day period. So if someone got a compensation increase or a bonus in 21, you'd be able to qualify all of those wages, assuming they were eligible, and wouldn't need to consider what they were paid in the prior period. We've hit on this a couple times, but it's important that for small employers, you're able to take all wages paid. If you're over 100 employees in 2020, or over 521, you can only claim the credit for wages paid where services were not being provided. That is not an all or nothing test. So if somebody is being paid their full wage or salary, but they're only able to perform services half of the time, then presumably you'd be able to take half of that person's wage for the employee retention credit. We've had several questions in the FAQ in the Q&A around how do you count employees. It's based on the 2019 employee count, and we are talking here about full-time employees, not full-time equivalents. So you could have a company that had 80 full-time employees, and then maybe they had 40 part-time employees, so over 100 total employees in 2020. But as long as their full-time employees are less than 100, they would still meet that small employer threshold for 2020. There's questions around how do you measure that? It's based on either a 30-hour work week or 130 hours in a month. So kind of tying back to some of those ACA rules that we look at, and it's based on an average. You average the employees per month in 19, and then divide by 12. A lot of our clients are either very clearly above or below that threshold. If you're close to that count, it's probably worth it to go through the detailed analysis and look at the different ways to compute the full-time employees and do that and see if you can get under the threshold. Another relatively minor rule, but important to note, that we are excluded from claiming any employees that are family members, including in-laws, of a more than 50% owner. So a lot of our closely held businesses out there have family members that are employed by the company. If they're related to the more than 50% owner, they need to exclude those people's wages from the credit. So diving into health plan expenses. So on top of the wages being paid, you can also claim the health plan expenses. And this includes both the employer portion, but also the employee portion of the health plan costs, as long as those are made with pre-tax contributions. So it's important. It includes both employer and employee. Self-insured plans are includable here. So you can include both the employer and the employee portion. The IRS has allowed in the FAQs using a reasonable pro rata allocation to figure out the per employee cost. They've also indicated that using COBRA rates would be one reasonable method for allocating costs. So you're given reasonable flexibility to allocate those health plan costs in a manner that makes sense and that you can administer. Jim talked about this earlier, but it's worth mentioning again. This is especially true for employers that are over that small employee threshold. If you've got employees that you furloughed but continue to incur healthcare costs, those employees are obviously not working, so they would be eligible under the not being paid but not providing services, and those health plan costs you're paying to those furloughed employees would be eligible expenses as long as you're an eligible employer for claiming the ERC.
So Joe laid out, hey, what are the kinds of costs we can pull in for the ERC? So I'll walk through a couple of examples. And in these examples, we're going to assume that we can hit the max per employee, so that $10,000 wage amount, including health plan expenses. But just to show you kind of the impact or the value of the credit, right? So, in example one, we have a quick serve restaurant that has 50 employees. And basically, they were partially suspended for both 20 and 21, and we're finding that to certainly be the case. Even though the restaurant or the dining room may be open, if you're limited in the capacity, which it varies by jurisdiction, right? I think I read in Illinois, they just opened up to 50% starting this week. But again, that's still a partial suspension, right? So if you look at 2020, their ERC, if they have 50 employees at that $10,000 max, so a $5,000 credit, that's $250,000 for just 2020. And then if they're assuming that we have suspension all the way through the end of June or at least through far enough into Q2 that we hit the max of 10,000 per employee. Again, it's a $7,000 credit for Q1, another 7 for Q2. It could be another $700,000 in benefit for those 50 employees. So, it really shows the difference there as far as the value of the credit and the change in the law, that 70% versus 50% by quarter. So again, it's significantly more in 2021. In example 2, we have a not-for-profit with 150 employees. They didn't meet the gross receipts test, but they did have a suspension of operations in 2020. But they didn't meet the suspension of operations in 2020. But they're going to go ahead and meet the gross receipts test in Q1 and Q2 of 2021. And again, that threshold, it's instead of a 50% drop, it's a 20% drop in gross receipts, so it's a little easier to meet. And in this case, they are above the 100 employees, but they're below the 500 employees. So again, we're looking at 2021 here. So as long as you're under 500 employees, we're not concerned about whether they're providing services or not. So again, if we can get to the maximum here of 10,000 per quarter per each employee, 150 employees times 14,000 is 2.1 million. So, it's a pretty sizable benefit if you can qualify. And given the change in the rules and how it's easier to qualify in 21, I think we're going to have a lot of clients that absolutely can take advantage of this in 21 that may not have met the test in 2020. A big part of that is, in this second example, over 150 employees, maybe they were suspended, but, these people could work and, they were getting paid, but they're still providing services. So, and from that aspect, we couldn't take the credit for them in 2020. So just a couple of examples there. So where are we seeing the most credit? And basically, as I look back to when the CARES Act came out, and we're like, man, this could be something that our clients take advantage of. And as we get to the end of 2020, we just didn't see a lot of clients that really took advantage of it. Again, PPP being the more popular provision, and it was mutually exclusive. So maybe we did 15 of these credits. Right now that the law has changed, we're seeing it all over. But just in our short experience with the extension, and even looking back into 2020, where are we seeing people taking advantage of the ERC? And so education has been a big one. Again, those private universities in 2020, they were certainly looking at it. Hospitality and restaurants, that was a no-brainer. That they've certainly been impacted. Retail, the same way. They especially, you look at malls were shut down from March to April. So they were certainly impacted. And, you look at businesses like that, and they're getting monthly rent from their tenants. So they weren't going to meet the gross receipts test. So they did have to qualify under suspension of operations. Healthcare, you think back to early March and April, even into May, you had a suspension of elective procedures, right? So since hospitals weren't able to do those, they were certainly subject to a partial suspension of business. Not-for-profits, this has been an interesting one in that generally I work with for-profit entities. The different industry groups, if you have an industry group that supports an industry, with networking events and lobbying, and, a lot of their revenue is driven by these member events that they host. But they can't host these because you can't have a gathering of more than 10 people in the state. And they had to cancel these. And it's not the same doing them online. Participation's not the same. But these are largely driven by member dues as far as revenue. So they weren't going to meet the gross receipts drop. But again, that's how they can qualify, as they were suspended. They couldn't host their annual events, whether it was a golf event or a big conference. So something to think about in the not-for-profit space. Banking, this is one it's been a little more fun in that they are essential businesses. So you really do have to say, okay, what kind of government order was in place? And gosh, did they shut down their lobby? Because if you shut down the lobby, I would argue that more than a nominal portion of your business is suspended. When you think about all the activities that happen in the lobby, and we've talked to a number of banks that they can show all kinds of metrics that say, hey, yeah, while PPP activity helped drive loans, you know what, transactions were down and all these other metrics are down. So you can certainly show that the banking industry was impacted by a suspension of operations. Sports and entertainment, absolutely. Whether it's casinos or you shoot, all the stadiums were empty. We had half capacity or third capacity at Super Bowl. I don't even know exactly what it was, but again, it's very clear that these industries were impacted, and some are fairly easy to see, right? Hospitality, others, maybe it wasn't. Oh gosh, I didn't really think about it that way. So again, that suspension of operations is out there. Is it black and white in all cases? Absolutely not. But for a lot of these industries, we can make a really solid argument that, hey, you were impacted by COVID, and due to a government order, you were partially suspended. So that's where we're seeing a lot of the credit. One more example I'll give, just because we talk about that 500 or 100 employee threshold, right? In the healthcare industry, I talked to a client that, again, they couldn't do those elective procedures, right? But they're well over 100 employees. So one of the things that they had to do is they had all these nurses that were on staff. And rather than furlough them, they said, hey, we're going to pay all you guys. We're just going to rotate you. So they put them on a rotating schedule. They tracked the time for basically all these nurses that were being paid but not providing services. So from that perspective, we were able to go in and calculate a benefit or a credit for them based on those hours. So again, that's just something to keep in mind as you look at your industry and your operations and say, hey, can I capture that information if I'm over that 100 employee threshold in 2020?
Hey, Jim.
Yeah.
We have lots of questions, and maybe we'll address a few of them here on this slide because they apply to some of the industries we have listed here. Before we do that, I want to emphasize that there are some businesses that are doing very well in COVID, and that does not necessarily mean you can't claim the ERC. So a good example, we have a client that has fast food restaurants, and they have a chain of them, and they are way up in terms of revenue in 2020 compared to 19. They've done very well as people have not wanted to, cook at home, at least after the first few weeks. But their dining room is closed due to government order. And it's very clear that even though their revenues are up, their operations are partially suspended. And we have examples in the FAQs. So I think that's a pretty clear example of still qualifying. So again, something to keep in mind that you don't have to show that you're in financial distress to be able to claim the ERC. And Jim, I'm going to ask you to help me answer some of these other fact patterns, and we won't have a chance to get to all of them. But one of the questions that came in on the Q&A was, hey, we've got a golf course that has a restaurant. The golf course remains open, but the restaurant remains closed. Are we partially suspended? So how would you address that one, Jim?
I would say absolutely. So, that would be a partial suspension of your business. Clearly, that's, part of the services you offer. And in that case, I think it's fairly bright line that they're partially suspended.
And it's important to note it's not just the restaurant employees that would be eligible. If it's the entire employee base. So it's not just the restaurant employees, would include the other employees as well. I purposely started with a softball because now we've got some more gray areas that we're going to see if we're going to test Jim's knowledge here.
Okay.
Or at least interpretation of very fuzzy rules. We are a senior living provider. We continue to operate 24/7, but we've had to suspend our tours and our move-ins, that sort of thing. Would you think that there would be a fact pattern there where that could be a partial suspension?
Yes, I do. And that's one I've been dealing with in a couple of different states. And the reality is they had to lock their doors. They weren't allowed to accept new patients. And basically, at that point, you're limiting commerce. So Absolutely, I'd say they are partially suspended.
All right, we've got another one, and maybe I'll try to tackle this one and then see what your thoughts are, Jim. So this is a little bit even more into the gray area. We have a manufacturer of ice creams and pastries and yummy things. Their customers are restaurants, and the restaurants are partially suspended. Does the manufacturer of the ice cream products have a partial suspension of operations? In the FAQs, we have the opposite scenario, right, where we have the supplier being suspended and the manufacturer that relies on some of those components from the supplier would constitute a partial suspension. We don't have the reverse of that example, at least from the IRS's standpoint, that says, well, what if you're the supplier and the folks that you're providing your products to are suspended, are you therefore suspended? So my personal thought on this is it's a gray area. We don't have perfect guidance, but you certainly have a strong argument. Now, on the flip side of this, the IRS has said that if customers, if you're, in the example of if you're an ice cream restaurant and customers aren't coming to your business because they have to stay home, that the IRS does not think that that is a partial suspension of operations. It's probably worth noting that the IRS guidance is not law, right? It's their thinking on this. So Jim, I'm being super vague on purpose, probably because we don't have a great answer, but how would you kind of look at that if there's a different way to think about it?
So, I guess I would agree with you, Joe, that I think we can make an argument. I would say that the IRS FAQs, like you mentioned, they're not, we can't legally rely on them, but they certainly make the alternate argument that, hey, if customers are required to stay at home, what they put in there is, hey, then at that point, you should try and qualify under the gross receipts test. Now, again, that 50% hurdle is a pretty big one, right? So, I guess I don't have a different way to view it, but I would agree with you that I think there's definitely a path there, and we can make the argument. It's just not, it's a little more gray.
And we are hoping that the IRS does this in the next round of FAQs, and we'll get into this later, issue more guidance on some of these other fact patterns that aren't quite so black and white.
All right. Some other considerations, Joe.
Yeah, on the surface, this provision seems relatively simple, but as we're learning today, the more you start to peel back the onion, there's more and more layers of issues. And so we'll go through some of the other major issues that we have to consider for this. And we've had quite a few questions around this topic here, and that's the whole concept of aggregation. So if you've got multiple entities that have shared ownership, do you have to combine them for purposes of the ERC? And I know a lot of companies that took PPP loans that are part of a shared ownership group had these same types of questions. It's a similar but slightly different analysis we do, and the short answer is if you are considered an entity under common control under Internal Revenue Section 42 or 414M or O, then you would need to aggregate and consider yourself as one employer for purposes of the ERC. And we'll try to dissect a little bit what's in those code sections I referenced for those who aren't super versed in that. The Section 52 rules deal with either parent subsidiary control groups or brother sister control groups. So for parent subgroups, we're looking at a 50% threshold. So if you've got a parent entity that wholly owns or owns more than 50% of an entity, even 51%, then those two entities would need to be combined as one employer for the ERC. If you've got brother sister companies, so you have a group of 5 or fewer individuals that have more than an 80%, so it's an 80% test here of common ownership, then those entities would also need to be combined under these rules. The 414 rules are a little bit more fuzzy. It's where you don't have direct ownership necessarily, but you have this concept of an affiliated service group, where essentially they operate as a business, but there is not shared ownership. So you think of maybe like a doctor group or attorneys, that sort of thing, is the most common example of entities that are part of an affiliated service group. Under the 414O rules, there's also additional criteria where if you show that a parent organization has effective control over subsidiary organizations. For example, you may have a not-for-profit entity where there isn't any actual ownership, right? But you have the parent organization has control over the board and who's on the board and that sort of thing. That would typically be a situation where you would have shared common control, and those would need to be combined for purposes of the ERC. So why is this important? Several reasons. This can potentially hurt you if you're looking at the gross receipts test and trying to qualify there. And if one entity that's part of a control group meets the test, but the others do not, and if aggregated they do not, then you would not be able to apply the test individually at that one entity. You need to look at the whole group. And also, maybe obvious, but I'll state it anyway, the employee count is important. And we've hit on this several times. And if you're looking at a control group of companies, you need to consider the entire employee count, not just of a single entity. This test can also help you though, especially if you're trying to qualify under the partial suspension of operations. Because if there's one trade or business, one entity that is partially suspended, all of the members of the group would be considered an eligible employer, even if only one entity or one location is suspended. So this aggregation rule can either help or hurt you depending on your fact pattern. All right, let's go to the next slide. Tax exempt. So we've talked about this. The ERC can be claimed by not-for-profits. There's no limitation on the type of an entity that can qualify under the PPP rules. Certain types of tax exempt entities were not eligible. We don't have those same rules for ERC. I know that changed a little bit on the PPP side for 21, but looking back at 2020, there's still those limitations for PPP, but not for ERC. Jim touched on this earlier a little bit, but just to state it one more time, the gross receipts for a tax exempt entity are determined under essentially, in layman's terms, all of the receipts that are reported on the Form 990 would be typically considered gross receipts for purposes of the ERC. And there's some we've talked through some of these examples, so we won't state everything again, but there's certainly impacts of these other rules in terms of partial suspension and aggregation rules on tax exempts as well. With that, Jim is going to talk about some of the interplay with other incentives.
Yeah, absolutely. So, and I'll go through these a little bit quicker. You know, gosh, when you take advantage of the ERC, there are some limitations, right? So you can't just be double dipping on everything. So, you know, for PPP loans, you know, you can take both the PPP and the ERC, but again, you can't use the same wages that you're using for forgiveness for the ERC, which, you know, makes sense, right? Eide loans, you can take advantage of those. You can still claim the ERC. The employment tax deferral, can absolutely take advantage of that, still claim the ERC. FFCRA credits, and you know, that's again something that came out in the CARES Act. You can take those along with ERC, but again, you can't use the same wages for FFCRA and ERC. Same for the work opportunity tax credit. Again, no double dipping there. Take one credit or the other. In this case, the ERC certainly a higher credit percentage. You know, the other thing is FMLA. Again, you can't double count the wages. The one thing that's interesting and near and dear to Joe and I's hearts, for R&D tax credits, basically in 2020, you can use the same wages for ERC and for computing the R&D tax credit. However, in 21, you can't double dip on that. So interesting provision there that maybe they just missed in 2020, but we're not complaining. All right, so talking about how to claim the credit, right? So this is something that everyone wants to know. It's like, okay, it sounds so simple, right? It's 70% or 50% of wages, and you know, but as you're finding, there's all these intricate rules. And then you get to the finish line, you're like, well, how do I get my cash back? So basically, you would report your total qualified wages and health insurance costs on a quarterly employment tax return. So your Form 941 for most companies, right? And what the guidance says is you have to go back and amend your 941 to capture the appropriate credit for that quarter. Now, they did have a catch-up provision in Q4, and this is and a slide we carried over. On January 22nd, the IRS released some guidance that basically gave us a week that said, hey, you can take your entire ERC on your Q4 if you originally file it. That came and went within a week. And so most people were back to the answer of, hey, we have to amend your 2020 Q2, your Q3, your Q4 941 to take advantage of the ERC. So that's where we stand right now. The other thing to note is you can receive an advance payment with Form 7200 for 2021. And so basically, if you know you're going to qualify, and again, because we can look back at Q4 of 2020 to see if we have that 20% drop in gross receipts, if you're going to qualify, you have 500 employees or less, you can basically file Form 7200, get advance of that credit. You can't exceed 70% of average quarterly wages. And we don't technically have guidance on this yet, but that's what the provision tells us. So, we're going to be at the end of Q1 likely before we get guidance, it seems like. So hopefully this is something we can take advantage of sooner versus later. But I think there's enough there. If we need to file it, we can.
Speaking of guidance, as Jim and I are talking to our clients, I always feel bad. We're the broken record of, hey, we're waiting on guidance, and so we'll play that record some more times right now. We are waiting on guidance, and the guidance we do have has been evolving. So I apologize that we're being vague and on some of these some of our answers, and the reason is we don't have great guidance. In terms of what's evolved, when the CARES Act was first passed, before we had any IRS FAQs, we had an interpretation of the statute from the Joint Committee on Taxation. Again, can't be relied on in a court of law, but it provides some interesting insights into how the credit can be administered and applied. And then the FAQs came out, and some of those have evolved. The furloughed employees, the IRS first said furloughed employees are not eligible for the ERC, and then after a strongly worded letter from Congress, trying to explain intent, they did take a 180 on that rule. The gross receipts for tax exempts, we talked about that. That's been evolving. In terms of what constitutes a partial shutdown, we've had evolving guidance around that. The IRS has introduced this concept of a partial suspension of operations. This concept of that the partial suspension of operations needs to be more than a nominal portion of the business. So again, using very subjective terms to describe a subjective test, but what is nominal versus not nominal, there's no guidance there. But as you're factoring in whether you think you're partially suspended, I guess ask yourself, has this had more than a nominal impact? I guess a quick example there that I can think of is if you're a restaurant and you're allowed to have folks in your dining room, but they need to be spaced 6 feet apart. If your tables were already spaced 6 feet apart, even though you're subject to that restriction, you probably haven't had a partial suspension. But if you've had to remove half your tables in order to comply or put X's through them so they can't sit there, in my view, that's not more than a nominal impact. So if you go to the IRS FAQs, you'll see this big alert, and I checked this morning just to make sure it was still there. It is. So we have a bunch of FAQs. However, none of them were released after the new round of legislation came out. So we're still waiting on guidance. And the biggest thing, go to the next slide, Jim, that we're waiting on guidance for is the interplay between ERC and PPP. And it's relatively simple. You say you can't claim the same wages for both. But again, when you dive into it, you start to have lots of questions. Many of our clients took, on their forgiveness application, may have put down way more wages than they needed to get full forgiveness, just because why not? You couldn't claim the ERC anyway. Maybe they took a $200,000 PPP loan, but they had $300,000 of wages during their PPP period, so they put the whole amount on their application. We're thinking the IRS will hopefully be reasonable here and allow you to claim that extra $100,000 in this example as ERC, but we're waiting on guidance on that. An additional thing to think about there is many PPP recipients simply use wages for forgiveness, even though they could have included rents and utilities and interest on their PPP forgiveness application. Again, this was all before we're allowed to go back retroactively and claim both. Will there be some provision that allows entities to essentially restate what was used for forgiveness? to be able to take advantage of some of those additional wages. We don't know. These are good questions. Jim talked about the 941s and we're waiting for additional guidance there. We're hoping there's a mechanism to claim the entire year on one filing instead of having to amend each quarter separately. If you're wanting to claim it for 2020 today, and the answer would be to probably amend each quarter separately, and we'll see if that changes as more guidance comes out. The other thing worth noting that we haven't touched on yet is that the ERC is subject to the 280C rules that essentially say you have to reduce your otherwise allowable deductions for income tax purposes by the amount of the credit. So if you claim $100,000 ERC, you do need to, that's tax affected. It's not a completely tax-free event. You need to reduce your deductions by the amount of the credit. The timing of that is going to be interesting, right? If you're claiming the credit retroactively for 2020, and maybe you've already filed your 2020 tax return, your income tax return, will you have to go back and amend that to make that reduction, which has a whole domino effect since your taxable income would change. It might impact your state filings, that sort of thing. Or will there be an administrative relief allowed for making that a little simpler and maybe allowing for that catch-up reduction on a 2021 income tax return. So we have lots more questions than we have answers, but those are some of the issues that we're running into quite a bit.
Let me interject here, Joe. So, talking about the interplay with the PPP loans. So the AICPA did send a letter to the IRS basically that said, hey, this law is retroactive. Not only should we be able to take that overage. So again, in your example, I think you had, 1.1 million in, wages, and you only needed 1 million to get forgiveness. That additional 100,000, should we pull that in for the ERC? Absolutely. The AICPA has even gone farther than that and said, hey, not only that, but even if you didn't claim that rent or utilities, you can go back and basically pretend like you did claim it for PPP forgiveness and take additional wages for the ERC. I think the AICPA is kind of positioning this being more aggressive, and maybe what we'll get is somewhere in the middle with the IRS. But if you're looking for that guidance, it's out there, or at least their thoughts on it. Sorry, not their guidance. One of the other questions I wanted to answer real quick, somebody asked about a PEO. If you use a PEO, there is guidance in the FAQs. That credit does come back to you, but there's that one's fairly cut and dry as far as the guidance, and you can find that on the IRS FAQs as far as how that works.
We're at the end of our time. Again, maybe we should have a full-time question answer on here with us because there's way more questions than we could get to, so we apologize. We've tried to address a lot of them in some of our verbal comments, and I typed a few answers along the way. We will get a report of all the Q&A, and we can follow up with answers after the webcast. But just to be respectful of everyone's time, I think we'll go ahead and wrap up. Thank you for your participation in this. We love all the questions. It shows that there's lots of interest in this credit. And if we can advance the slides, Jim, it will pop up our contact info. But again, we'll be reaching out with additional answers to some of the questions that were submitted. And thank you all again.